Welcome to Talk Tickers. Today, we are digging into the Agenus Q2 2025 stakeholder briefing that dropped on August 27th. Now, this wasn't your typical earnings call. It was really more of a strategic update, and, well, the market definitely had something to say about it.
Yep, that's the number, a drop of almost 2% right after the call. Now, at first glance, you might think, ouch, that's not good. But honestly, the story here is way more interesting than just one little number. So let's unpack what really drove that reaction and what the company is actually focused on.
Okay, first things first, let's talk numbers. We're going to look at the headline financials and see exactly how Agenus stacked up against what Wall Street was expecting.
So, starting with the bottom line, Agenus reported a GAAP earnings per share of -$1. And, to put it plainly, that was a pretty big miss compared to what the analysts had penciled it.
And it wasn't just the bottom line. If you look at the top line, revenue came in at $25.7 million. So again, falling pretty short of the forecast. All in all, this paints a picture of a financially tough quarter for them.
And when you see it all laid out like this, you really get the full picture of that disconnect. I mean, a 22-cent miss on earnings, okay, that happens. But a $24 million gap on revenue? Whoa. That is substantial. Now, they said it was mostly due to some accounting stuff with non-cash royalties, but at the end of the day, a miss is a miss, right? And it for sure got the market's attention.
But wait, it wasn't all bad news on the money front. Here's the bright spot. The company actually cut its operating cash burn by almost 40% compared to last year. And that's a really big deal. It signals to investors that, hey, we're getting serious about managing our spending and making our cash last longer.
And this really gets to the heart of the whole briefing. You have this huge contrast, this tug-of-war really, between the cold, hard numbers on the spreadsheet and the compelling clinical story that management was really trying to hammer home.
Let's look at this side by side, because this is everything. On one hand, you've got the spreadsheet reality, right? The misses we talked about, and a pretty modest $9.5 million in cash left at the end of the quarter. But then, you look at the other side, the story. And it's powerful. We're talking a 42% 2-year survival rate in a really tough-to-treat cancer. We're talking about getting the green light from the FDA for a big Phase 3 trial, and a $91 million cash injection that's just waiting to close. See the difference?
In this quote from the CEO, Garo Arman, it just perfectly sums up the vibe of the whole call. Patients don't live on bureaucratic time. They live on cancer time. The message was basically, look, forget about all the short-term noise. Focus on what matters. The patients, the urgency, and the massive potential of our main therapy, BOAT/BAL.
So, to prove this wasn't just talk, management laid out a super clear roadmap of what's coming up next, the key catalysts. First, that Zydus deal should close in Q3, which will be a huge boost to their cash position. Then, we're expecting more data to drop in the second half of the year. And the big one, the pivotal Phase 3 trial, codenamed BATTMAN, is set to kick off in Q4. These are the exact milestones that are supposed to take risk off the table.
Okay, so with all that in mind, what's our final analysis? Let's get into our take and what we're going to be looking for on the next call.
This slide pretty much sums up the whole debate around this stock right now. If you're a bull, you're looking at that incredible clinical promise. I mean, that 42% survival data is hard to ignore. The path with the FDA looks clear, they've got cash on the way, and they're spending less. But if you're a bear, you just can't get past those financial misses. You're worried about the risk of actually pulling off a huge Phase 3 trial, and you know the market is probably going to sit on the sidelines until it sees that rock-solid randomized data.
So, this brings us to the million-dollar question, doesn't it? When you weigh the story against the spreadsheet, the potential against the actual performance, what's the call on Agenus?
We're rating Agenus as market perform, and here's why. It perfectly captures that tension we've been talking about. The clinical potential here is huge, absolutely transformative. But you can't ignore the financial reality right now and the massive execution risk ahead. The company has laid out the path, but now they actually have to walk it.
All right, let's move on to our final segment, what we call the not financial advice segment. I want you to imagine you're sitting in on an investment committee meeting at a hedge fund. We're going to pitch a speculative but plausible trade idea based on everything we've just discussed.
So the idea here revolves around what's called a catalyst-driven options strategy. All that means is it's a trade designed to make a profit from the stock moving around a specific event that we already know is coming up, a catalyst.
Okay, so here's the pitch. The core thesis is simple. The market is punishing the stock until Agenus proves it can actually deliver on its promises. So, the action? You'd acquire some long-dated call options, think more than 6 months out, to give yourself enough time.
The specific catalysts you're playing for are the closing of that big Zydus deal in Q3 and the official start of the BATTMAN trial in Q4. The whole goal is to be in a position to capture the upside if the stock gets a nice re-rating after the company knocks down these major milestones and takes some risk off the table.
And of course, the most important part, I have to say it. This is not financial advice. Every investment strategy has risks, so please always do your own homework.